This is Jody Trana with Chapter 5, Part 1 of Business Finance. In this course, we are now in our middle section of the course, which is identifying and practicing business finance tools. We're starting that out with Chapter 5, learning about the time value of money. Hopefully you remember back to our introduction about these 5 principles of finance. We talked about the story of the shrewd manager that's in Matthew 25 when we were talking about money having a time value. In this story, there was a manager who had given his servants different amounts of money to take care of. And he expected that that amount of money should grow over time. That's because of this very principle. The value of a dollar changes over time. If I were to promise you $1, you would want it now, not 3 years from now, because $1 today is worth more than $1 in the future because you can invest it and turn that into opportunity money that earns interest or profits. It could be worth $1.50 or so 3 years from now. Albert Einstein said, "Compounding is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." Compounding is the first of the 2 concepts we're going to be learning about that relates to financial principle number 1, money has a time value. When we try to figure out how much the future value will be of today's money, that's called compounding. When we're trying to figure out today's value of a future amount of money, that's called discounting. So the question is whether we're trying to figure out a future value or whether we're trying to figure out today's value. We'll tackle compounding first and then save discounting for the next class. Let's talk about compounding. Would you take $1 million right now, or would you rather have a future amount that starts with a penny today and is doubled daily for a month? Think about it.
Penny double theory states as follows. If I give you a choice between choosing $1 million today and one shot, or I give you a penny doubled for 31 days, which will you choose? What does a penny doubled mean? Means day 1 it's worth 1 cent, day 2 it doubles that, so it's 2 cents, day 3 it doubles that, which is worth 4 cents, and day 4 is worth now 8 cents. And it goes on and on and on. Which would you choose? So of course most of you choose the $1 million because I offered you that question. And you probably made the right choice because listen to the numbers. At day 20, all you have is $5,242.88. That's it. At day 25, when you only got 6 days left, all that you have is $167,772.16. You lost over $800,000. However, if you go to day 31, you will find yourself having $10,737,418.24. And why do we focus on 14 cents? Because recognize if we would start at day 1, 24 cents, how much greater will day 31 be?
Did you choose the right one? As you can see, Albert Einstein was right. Compounding is truly a wonder, and those who understand it will earn from it. Let's take a look at an example that's a little bit more realistic. Here we have 3 investment cash flows. Susan invests $5,000 every year between the ages of 25 and 35 years old. So that's a total investment of $50,000. Bill invests $5,000 every year between the ages of 35 and 65. So he comes in starting to invest later on in life. but he does invest a greater amount of $150,000 total. And our third example is Chris, who invests $5,000 every year for the whole entire amount that we're talking about with Susan and Bill through ages 25 to 65. In total, he invests the whole amount of $200,000. So if I were to ask you who will have the greater amount at the end of this investment period, who would you say? I hope it made sense to you that Chris would end up with the most money. He put the most money in. He saved an astronomically larger number than both Susan or Bill. But what's the most interesting to me is the difference between Susan and Bill. Susan, who saved for just 10 years, has more wealth than Bill, who saved for 30 years. And Susan only put in $50,000, where Bill put in $150,000. All of the investment returns that Susan earned in her 10 years of saving are snowballing. They're compounding over time. Because these three investment issues are familiar to you now, I wanted to show you how those problems would be stated if it was an assignment for you. So for Susan, the Pearson materials would say something like, if Susan invests $5,000 per year for 10 years and nothing more for the next 30 years, how much money would she have after 40 years? For Bill's situation, it would say something like, if Bill invests $5,000 per year for 30 years, how much money will he have after his 30 years? And third, for Chris, it might say something like, if Chris invests $5,000 per year for 40 years, how much money will he have after 40 years? I showed you some examples of what problems would look like, but now we're going to actually work through one. The first problem we're going to talk about is, if you put $100,000 into a savings account today, earning 7% interest compounded annually, how much money will the savings balance be in 10 years? Every time you have a problem like this, you're going to do a step-by-step process, whether it is formally or informally. The first thing you're going to do is to draw a timeline. We're going to start by drawing timelines on paper, and you will probably proceed to do that in your head at some point in time. The second step is to identify the elements that we know in order to determine the elements that we don't know to solve the problem. The third step is to actually solve the problem. And the fourth step, and please do not skip this, is to analyze and check yourself. Does it make sense? Does the answer make sense? And should I maybe calculate it another way in order to be sure that I got the right answer? When we draw a timeline, we need to label it well because that will be the information we need in order to solve the problem. The first thing we might do is to draw the line and put some notches on it for the number of years that we have. We always want to start out with a 0 because that is today. The next thing that I see on here is our cash flow balance, which is a negative 100,000. That means that we have taken it out of our, let's say our purse, our wallet, and we've put it into a bank. So it's not in our hand anymore. We can go get it at any time, but that's why we put a negative here, because we are releasing that 100,000. We also note that it is a 10-year time period. We also note that it's earning 7% interest, and we have a question mark beside the future value. That's the element that we don't know in this question. The next step is to identify the elements. You may have done a good job of labeling these on your timeline, but it does help to also have a list of them. So we'll be practicing that as well. So PV stands for present value, and remember that the present value was a negative 100,000 because we have taken it out of our possession and put it into an investment. The FV, future value, is unknown, identified by a question mark here. The payment is 0. In our examples before, where we were talking about annual investments into a retirement account of $5,000 or so, that would be a payment. This one, we don't talk about a payment at all. We talk about one initial contribution, and that's all. So for this example, our payment is 0. For the interest, we're going to either call this a 7% interest, or we're going to do 0.07. And this kind of depends upon the way that we're calculating our final answer. N stands for the number of years, and it is 10. Now that we have identified the elements, the present value, the interest, and the number of payments in order to identify the future value, we're going to solve this in 4 different ways. All 4 ways we should get the same answer. Those are using a present value and future value table, using a math formula, using a financial calculator, and using Excel. We're first going to use the present value and future value table. We're really going to use this initially as nostalgia. This method was used by everyone a few years ago when financial calculators were expensive. Today we don't rely on this method, but you still need to know how to use it. The present value and future value table is in Canvas. It lists interest rates across the top of the table and periods of time down the left side of the table. If we follow the column for 7% down, it will intersect with the 10-year row at this multiplier that is circled, 1.9672. That's the multiplier that we need to solve this problem. We take the multiplier and we multiply it times our $100,000 to come up with the value of our balance in 10 years, which is $196,720. I will make note that because of the rounding that happens in these tables, using the tables will not work with MyLab. Our second method is using the math formula. This method appeals to a lot of people who are comfortable with math, and you should come up with the correct answer. The math gets a little more difficult as our problems get more complex, but this one we can follow through with quite easily. So we need to know what the future value is. That's what we're trying to calculate. So we will take this equation and plug in all of the information that we know. We know the present value. We also know the annual interest rate, and we know the number of years for this, this growth pattern. Here is our equation with the numbers filled in. I want to go through this first line with you. So it says 100,000 times 1 plus 0.07 to the 10th power. Here we've used a whole number of 100,000, not negative 100,000. And the reason we have is because we want to end up with a positive number. So even though on our timeline we showed a negative 100,000, that is not necessary here. Also, notice that here in the math formula we need to use 0.07 and not the whole number 7 for our interest rate. For math purposes, when we have 7%, the true math number of 7% is 0.07. So that's why we've used that number here. The first part of the calculation is to take 1 plus 0.07 to the 10th power. And you'll see when we've done that, that we come up with our multiplier that we used in the last problem. So that's where the multiplier comes from. And you'll also notice that here is a different rounding of the multiplier. So we would come up with a slightly different answer, but very close, of $196,715. Now we're going to take this same problem and solve it with the financial calculator. You may have your own financial calculator. In the class, we're going to use the Pearson Financial Calculator app so that we can all be talking about the same thing. You may choose to use this or to use your own. Take a moment right now and pause the video and download this app on your phone. The financial calculator looks like this. I've drawn a red line around the buttons that you'll be using for this chapter. Enter each element into your calculator by entering the number and then assigning it to an element by pushing the N, the I, or the PV button. You will be entering the initial contribution as a negative number, just like we talked about related to the timeline. You will also be entering the interest number as a whole number above 0 for the Pearson calculator and most other calculators. We do not use 0.07 with a financial calculator. The payment is 0, as we talked about, so you don't need to enter that. Now press the Compute button, that's the CPT button, and follow that by pressing the FV button for future value, and your future value will calculate. Here you can see my number is $196,715.14 rounded up. Finally, we'll talk about the Excel method. Excel is my preferred method of all 4 of these by far. With Excel, you can set up a problem and use the same setup over and over again. And it's much easier to track your process for problems if your answer isn't coming out right. It's also a lot easier to get help from me because you can send your Excel template to me and say, this is what I did. It's very hard for you to explain to me how you calculated it on a calculator. Once you get the template set up correctly, it will work correctly over and over again. Excel has built-in formulas for all the calculations we need to do in this class, so you won't be entering complicated math problems. Here, all you need to do is tell Excel you want to solve a future value problem. That's FV. Then you enter the elements of the problem into the parentheses and do not enter the actual numbers. Enter in the cells where these numbers will be located. Then all you have to do is hit enter and your number is calculated automatically. You need to enter the elements in the order expected, which is the rate first, then the number of periods, then the payments, and then the present value. You should put payments into your formula even though you don't have any here because you will have some in the future. Here you can see our answer is $196,715.14, just as it should be. If you are getting a negative number for your answer, it's probably because you didn't enter the present value as a negative number. I've given you some notes to try and help you to remember, but your present value needs to be entered as a negative number. And you'll notice here that interest was entered as 0.07. And probably now the most important and least favorite step is to analyze what you've done and to check yourself. Especially the first time through on your financial template in Excel, you may want to check your answers by doing the math or running it through on a calculator. You do have the added benefit of entering your number into MyLab to see if it's correct. But what if you didn't have MyLab? What if you were using other numbers? You'd want to make sure that your calculations were correct. So make sure that it makes sense. Consider the reasonableness. For example, if you do get a negative future value number, that isn't very reasonable. So you'll need to go back and double check. Here's a summary of what we did today. To analyze and solve a problem such as putting $100,000 into a savings account that earns 7% interest compounded annually, how much will the savings be in 10 years? We first drew a timeline that helps us consider what type of a problem it is and what the elements are. We identified the elements to determine the solution strategy. We solved it 4 different ways. We used a present value, future value table. Remember that the rounding in this table makes this particular process not friendly with MyLab. The second way, we used a math formula, we used a financial calculator, and we used Excel. The fourth step is to just take a minute, consider your answers, analyze, and check yourself.